Yeah.
Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mumme. The goal of my show is very simple. It's to learn from those who have mastered their craft of what they do. If you are new to my podcast, please be sure to hit the subscribe button. Today, we have a new guest on the show, and his name is Matthew Piepenburg. So for those of you that don't know Matt, he is the partner of Matterhorn Asset Management and a board member at signalsmatters.com. Without further ado, Matt, welcome to the show.
Well, it's great to be here. I'm looking forward to the conversation. It's really exciting.
Same here. So, Matt, before we get kicking here, I really want my listeners to get a better understanding of your work. So, tell us a little bit about your origin story. What
Mhm.
inspired you to pursue a career in the financial world and become a managing partner and fund manager?
Yeah, a lot of it was a series of ridiculous mistakes and then some luck and a little bit of conviction. Um, you know, my background was not at all financial or Wall Street. I grew up in the Midwest in a very um, I mean, every story is unique, but mine was particularly unique in the sense that I had an American life and a European life. I had a private school life and a public school life. I had a very academic life and a very athletic life. I had a Midwestern life and then a German life. And again, just all these different influences. My parents were not at all financially savvy. They were the offspring of wealthier parents and were hippies. And I grew up in this kind of Charlie Russell Lowell family where my mom was reading transcendental books about philosophy and literature, kind of like Charlie Russell Lowell in the early 1800s with Emerson and Longfellow running around the house. And my mom was always with artists and thinkers, and they were kind of very anti-Wall Street, although their parents had been hardworking executive types. And so they were the opposite. So I kind of grew up trying to figure out my place in the world. I was heavily into sports, but I had a big chip on my shoulder about not just being another athlete. And I wanted to get out of the Midwest, but I had the values of the Midwest. I had a German side father, and I wanted to learn a little bit more about Germany and its problems and strengths. Went to school in Germany as a young kid, and then played a lot of sports, got into some good private schools for sports. But when I got to these prep schools out east, I wanted to make sure that I wasn't just there as a scholarship student for sports. I wanted to do well in school, and I worked really hard at hitting the books. But I always had a love of history and philosophy and the bigger questions of how the man is and how the world is made. So I wasn't really looking at economics and macroeconomics in high school or undergrad. In fact, went off to law school, didn't think I'd be doing anything selling bonds for a big bank. That was the big thing to do out of college. I interned at some big banks and didn't like it, thought law school would be interesting. Went to a very good law school, learned about the Constitution, the laws, and to think like a lawyer, but I still wasn't thinking about markets. I'd made some really, really good friends along the way, and I had this kind of hippie influence from my parents. You had a kind of a desire for something a little more fundamental. So it was always kind of bouncing back and forth between being curious philosophically, being realistic and pragmatic as a Midwestern German American, having a huge European influence and a very, apple pie baseball American influence. And when I'd just taken the bar exam. I had a young wife, a new baby. We were having a great life with the law firm and the secretary and the view of the ocean. And it was the American dream. And I was bored out of my mind. And a great friend of mine from high school or boarding school who came from a very wealthy family, who was an investment banker, making 50 times the money I was making as a young lawyer, said, we're going to start a hedge fund. And this was in the dot-com bubble in the late 90s. I didn't know a stock from a bond, didn't have a clue what I was doing, but there was a massive bubble in the NASDAQ. And I told my wife, well, I'm pretty bored as a lawyer. I've got all these degrees. I don't know what I want to do. And I kind of by default rolled into Wall Street with the help of friends, family, and fools. At that time in the late 90s, you started a hedge fund if you had some wealthy uncles, so to speak, and learned as I went. And it was interesting because, again, I was very humble. We were both novices and neophytes. We didn't really understand the markets. There was a huge bubble. We got into some pre-IPOs, which at the time would be like Bitcoin at $10. We were buying pre-IPOs. We didn't know what we were doing. Goldman Sachs was underwriting them. We had contacts there. We got in on some of these IPOs. Most of them struck out. One was a home run. And before you knew it, we were in our late 20s and we had this problem that everyone loves to hate. We got lucky. We got really lucky. and we made more money than anyone could deserve and earn in your late 20s, more than my parents and grandparents made. We were completely off our rockers and confusing luck with skill. I knew it was luck, but long story short, it meant by 1999, 2000, I had to be responsible for this high class problem of actually managing wealth because I had never really seen anything like that before. And I had to truly understand the markets because now it was a responsibility. Again, cry me a river. Your big problem is understanding how to manage wealth, and you've just hit a lottery ticket on the NASDAQ during a dot-com bubble in 2000. But it was interesting because that bubble was still very big going into 2000. I was still trying to figure out how the sausage was made on Wall Street. I learned a lot about overvaluation and central bank policy then, but it wasn't really until after 2000 when I liquidated from my position just before the markets tanked in April of 2000. And that was less luck than just fear. That was the lawyer in me, the common sense Midwestern practical person saying, this is a bubble. I've won a ticket. I'm going to keep the cash. Something's going to break. And it was after that point in 2000, in April of 2000, when markets and the NASDAQ started to turn over. And then by 2003, the NASDAQ was down 80% from its highs, that my baptism by fire and my lottery ticket by chance coalesced. And by 2003, I had to start thinking more like an economist and a fiduciary than a lucky dot-com lottery ticket winner in my 20s. And that's really when my education in the markets became important to me. And it goes back, and I'll stop in a second, but it goes back. I think at that time, I really wanted to understand how the sausage was made on the NASDAQ, the S&P, and the Dow, how central banks worked, how bubbles worked, because I'd just gone through one. I've been the beneficiary of one, but they scared the hell out of me to see how that went from the sublime to the ridiculous in a matter of years. And then we had a family office, and we worked with family office. We commingled funds, and we were allocating money with shared money. And I had to start thinking real seriously about how to critique other portfolio managers, other hedge fund managers that were better and worse than us. I just had to start to learn how it was made. It was very curious, and that curiosity really led to an understanding of the history of how money is made, how markets work. So it was really after winning this lottery ticket, after this kind of hippie jock intellectual youth, all of it kind of coalesced. By the time I was in my early 30s, I started leaning into the table of how markets really work in a cynical way, in an objective way, maybe in a biased way. But it was a long journey from being an indifferent kind of philosophical geek and jock in my high school and college years to being a more serious historian of markets and critique of portfolio management in my early 30s, that it all started to come together. Now I'm in my 50s, getting old, and there's still constant things to learn. But that was in a nutshell, my evolution from student kid to hedge fund manager to now. I'm in a position where speculation, markets, sectors, bonds, stocks, yields, all extremely very important. But I'm in the precious metal space with Egon von Greyerz, who's an icon in the gold space. Many people misunderstand gold, but gold for me and for our clients and for Egon is really a wealth preservation asset. It's not as sexy as SPACs or Bitcoin or cryptos or speculation in different sectors of the risk asset stream, but it really is a little bit less sexy, but extremely important now because it's about preserving wealth, not just making wealth. I know people have different goals. Speculation is important. I certainly know that, but preserving what you have is important. Currency risk is important. So I got into the precious metal space, not as a gold bug or a gold bull, but from my common sense understanding of money and currency risk and bond market risk. It all kind of came together really in the last 7 years, 8 years. I've really tried to understand currency risk and bond market risk. So now I'm really looking at something very boring, that pet rock, physical gold that you throw in the ground and it stares back at you and you pay a fee for it. It's much more than that. But it took me a long while to go from being completely ignorant to being a lucky speculator to then thinking about preservation. And along the line, I learned a lot about the bond market and central bank policy and debt.
Well, thanks a lot for, sharing your background with my listeners. It's very clear that you've always been really curious, to navigate the complexity of like the financial world. And, a question that I kind of want to ask you that I'm curious is, while you were kind of navigating, the financial world, were there any mentors that really stood out to you that had a huge impact in terms of helping you with your learning curve?
Absolutely. I mean, I think There always has to be, right? And if there isn't, you should find one. I tell that to my own kids now who are in their 20s. Go look for someone you admire, find a way to get under their wing and learn. And at the very beginning, when we were 20 something knuckleheads just throwing darts at the NASDAQ, I didn't have any mentors and we got lucky. We could have been ridiculous, but we got lucky. As soon as reality clicked and I was responsible, I went out seeking mentors and found them, whether they were portfolio managers or even clients of ours who were very successful, or the father of my business partner who was very successful. Um, and then later, when I was managing my own funds myself, a lot of them were Vietnam veterans who were also Wall Street veterans who'd seen the suck, so to speak. They'd seen cycles, they'd seen adversity. Tom Lott, a good friend of mine who I admire, who was a mentor at Morgan Stanley, but he graduated from Yale in 1968, young and blonde and happy. And the next thing you knew, he was on a boat to Vietnam. Very interesting life. These kind of people fascinate me because you go from these extremes, and whether it's in combat or whether it's in Wall Street, he came back from Vietnam, obviously different than he came in. And then he's responsible for getting a career, understanding markets, worked for the World Bank, worked for the IMF, worked for Morgan Stanley, years trading portfolios. What those people know after being in their 50s and 60s, or going through war, going through market cycles, going through life, raising families, what they can teach a 28-year-old or a 30-year-old is extraordinary. And so I had those kind of mentors in Wall Street, in even the private sector, like Howard Johnson, who was the father of my best friend and business partner, who started his own businesses, started from nothing and built massive businesses. Taught me about balance sheets, taught me about free cash flow, taught me about discipline, taught me about hard work. Those things sound Pollyannish, but they're essential. And when you don't find them in flesh and blood, like I did in Wall Street or in the markets, even in school, whether it was good coaches versus bad coaches, or really good professors versus those that were just there looking to get a paycheck, you can always find the ones that are passionate about you. If you're passionate about what they're teaching, or you're passionate about what you want to learn, you'll find a mentor, and they'll be willing, if they're really passionate, they'll be willing to help. And even when you can't find good professors or good managers or good business partners or examples to follow, there's always great books to read too. If you're genuinely passionate about anything, whether it's water polo or horse polo, whether it's baseball or markets, um, you got to find the best athletes, and you got to trigger them, and you got to follow them, and you got to mimic them. And then you got to be humble enough to admit you don't know what you're doing and ask them to teach you, because you can learn a hell of a lot from what they've learned and the mistakes they've made and the successes they've had. You'll also have to make a lot of your own mistakes, but be ready for that. Have your own injuries, overcome them. You've got to have them. I also had great books. So the combination of great partners, great mentors, great books, it wasn't luck. You have to find that. You have to find those. You have to track them down. And I tell my son and my daughter, don't just go work for Goldman Sachs. Go find a mentor. Go find a guy in the bond desk, or a gal in the bond desk, or someone who's been through cycles. And if you're interested in that space, whether it's precious metals or stocks or private equity, or gymnastics, whatever it is you're interested in, or horses, find someone far better than you. If you're interested, be humble and listen, and don't worry about the paycheck right away. Learn about the knowledge. And I found that has been far better than just throwing resumes around or just hoping for a lottery ticket. Now, I happened to get that lottery ticket, and I was very lucky, but I made my own luck by taking risks, by leaving a lucrative job in a law firm to go for it, to take some risks. And I trusted my partner, even though we didn't know a lot. We had good mentors, we had good advisors, we had good connections. All of that came from taking the effort to be humble, to ask for help, and to ask for guidance, and staying curious. And I'm 54 now, and I'm still constantly curious about debt markets and bond markets and asset classes, because they're changing constantly. Certain trends and patterns stay the same, but there are always unique vicissitudes to every market cycle. And I'm always looking for smarter people. Rick Rule is smarter than me. Egon von Greyerz is smarter than me. Tom Lott is smarter than me, but they're all at least 20 years older than me, and they've learned a lot more, because the days teach things that the years don't notice, and so you've got to find these people, and it takes a bit of discernment and humility and common sense to track them down and find them. And I'm still looking for them. They're all over the place in the markets. You just have to knock on their doors.
It makes me think, I wrote actually in college, a research paper on expertise. And how it's really achieved through, mastering coaching, which is what you just talked about, having mentors or, teachers or coaches that, have had a positive impact, whether it's
Yeah,
negative lessons or positive lessons. And then
sure.
there's also, deliberate practice, right? So being curious and refining like your investment skill. So I really
Yeah.
appreciate how you related that not just to the financial world, but also in terms of life.
Oh yeah.
That's exactly how I've, brought out from different guests across different domains, like, these commonalities. The next thing I want to talk about is I wanted to start with a question that you've never been asked before. So if you were
Mhm.
to think of one question that you've wanted someone to ask you, what would that be and why?
Yeah, in when since my expertise in this particular context isn't about horses, it's about markets, and I think your audience wants to hear more of my views on that than the other. One thing that I think was critical is I came up inadvertently, like an accidental tourist in the markets, and then slowly became, I think, at least a modest expert in the markets is in dealing with hedge funds and private equity funds and private wealth management slides of different banks and talking to clients and talking to the buy side and the sell side of Wall Street and looking at people struggling to make wealth or retain their wealth and seeing all the good, the bad, and the ugly in all of those areas, from banks to hedge funds to private wealth management offices to family offices. The one thing I think I don't hear enough of, and Charlie Ellis raised this more than once years ago, a great author, financial author, what's the difference between a fiduciary and a salesman? Who on the other side of that desk, whether when they're trying to sell you a service or expertise or a product or a portfolio, are they fiduciaries? Do they have a best interest in protecting you and mentoring you, or are they salesmen looking for a fee structure that benefits them? And that can even be with central bankers and politicians. What is their real interest? Are they true fiduciaries with an interest in cooperating beyond their own self-interest, or are they just fee gatherers looking to get their 2 and 20 or their 1 and 10 or their 1% of their bips on selling you projections rather than teaching you about how their product or service works? I've sat on both sides of the desk when I was allocating money to other managers or investing money in private equity, or even trying to understand precious metals. After a while, you get what Hemingway calls a good bullshit detector. You learn that over time. Who's in this space? Whatever, whether it's bonds and stocks or precious metals or private equity or cryptos, they are legitimately sincere, passionate, genuine products and services, and they are just fee gatherers. Those are the salesmen. And everyone's cynical. I'm cynical. It's the philosophical background to me. What is man's nature, from Locke and Hobbes to Nietzsche and Schopenhauer? Who's really trying to be sincere? Trust is very, very hard to gauge sometimes. There are in my space huge differences between those that are really genuinely passionate about what they're doing and will teach the clients or their partners about what they're doing, and there are others who are looking for themselves and a fee and a way out. And it's very hard for investors when they're relying on third parties or hedge fund managers or service providers sometimes to trust. It's hard to trust your media. It's hard to trust your political officers, left or right. It's hard to trust your central bankers. God knows it's hard to trust, you know, the guys who are on the private wealth management at Morgan Stanley or Goldman Sachs. Are they really genuinely there to protect you, or are they just part of this juggernaut and they need your AUM and they want to take fees off it? Are they going to actually help you? And I think I've tried really hard to be a fiduciary to my family and to my clients and to myself rather than a salesman. And I think it's an important distinction. When I was a managing director and a CIO of a family office, it wasn't my money. We had billions in the family office. It wasn't mine. I'm not saying that, but it was, a lot of different families coming together, and we were able to therefore get in front of any hedge fund manager on the planet Earth, whether that was in Chicago, whether that was in Boston, whether that was in London, or of course in New York City. When you have that kind of money behind you, you make a phone call, they'll sit down with you. You'll get the portfolio manager, you'll get the founder, you'll get the best analysts. and you'll hear from the good, the bad, and the ugly. And that was interesting experience, probably one of the best experiences, talking to hundreds of really sexy portfolio managers from the best names. I found that when we allocated to those figures, the ones that made me the most interested and were often the most successful were not the ones that were promising this kind of return annualized, or that we never have drawdowns. And these are our projections. The ones that were promising were salesmen. Come on, nothing's that easy. And if it is that easy, there's a problem. The ones that I liked, and I'll say this again and again, were the ones that started the conversation with risk first. This is the risk. These are my premises. These are my assumptions. These are my allocations. This is where it could go really well if I'm right. And this is where it could go really wrong if I'm wrong. And here's what I'm doing to protect us if I'm wrong. These are the things that I question about my own convictions. Those were more honest. Those are more fiduciary. They were more concerned about cooperating with me and my concerns than trying to sell me something. I think I think that's true in romantic relationships and personal relationships, in athletic relationships, and certainly in financial relationships. Find people that have a shared interest, that are looking in the same direction and not just looking into your eyes to tell you what you want to hear. Be skeptical, but the ones that are the most honest about the strengths and weaknesses of their convictions tend to be fiduciaries. And I think if you're not trading or investing on your own and you're relying on third parties, be skeptical, but look to those who are not afraid to talk about their own doubts, their own risks, their own concerns, as well as their convictions. I think a fiduciary actually cares about you as much as they care about themselves, which is what we want from our politicians or our journalists or our coaches or our horses. We want them to be faithful, right? We want them to be in the battle with us. Many of them are not. Many of them are there to get a fee and to basically parrot what they've been taught to parrot. In Wall Street, bears and cynics are fired and bulls are always hired. So it's very hard to get an honest conversation with a private wealth manager at a big bank. It's very hard to get an honest conversation from someone peddling crypto, an alternative asset, or some SPAC, or some other sexy, no fails, perfect get rich quick scheme. Those are typically eyebrow raising for a reason. You should question that for a reason. You should question everything I say about gold for a reason. I always ask, if I have a view, take the opposite view, then make your own decision. I've spent years trying to come up with contrary views to my own convictions, so I don't become just a salesman to myself and to my to my friends and to my colleagues and to my clients. So again, that's the question. And that's the thing I've struggled with the most on Wall Street in particular. And even when I was a young hedge fund guy in my 20s and we went from bank to bank getting sold these IPOs, my partner and I knew they were nonsense. They were total salesmen. But we also knew we're going to take that risk because we'll swing at 5 pitches and see if one hits. But we never trusted the guys that promise us this is a 10 bagger, this is a 12 bagger. Usually 10 baggers and 12 baggers, as Rick Rule said, take years to get, not minutes, months, or weeks. At that time, we were young and dumb and just wanting to speculate and take risk, and it was really arrogant. But we knew we were just taking risks. Now, when you're getting more serious, try to find and associate with people, whether they're giving you advice or giving you a product or a service, that are humble about the downside and the upside, not just promising the upside.
I'm really happy that you brought that up, because even sometimes we even see with salesmen, they don't even have skin in the game, right?
Right.
Or they're truly not authentically looking at risk, kind of like you
Yeah.
mentioned.
Yeah.
And that makes me actually want to talk about, in October 2022, you co-authored the book called Gold Matters: Real Solutions to Surreal Risks. So it's very clear that you're passionate about risk and
Yeah.
that you've done a lot of research, a lot of due diligence. So my next question that I want to ask you is, why did you decide to publish this book? And what are the main points you wanted investors to better understand?
Yeah. And this again, my bias, and you should question my bias because I am almost always cynical, and that can be a problem. But I also lean into the table of bull case arguments or positive arguments. There's a lot that's positive about the world, about markets, about opportunities. But in a nutshell, I am extremely objectively and empirically and I think historically confirmed, worried about the global economy in general and US markets in particular. And I have been for years, even though I've traded bull cycles and shorted bear cycles, and there are opportunities all the time if you're in the game. Ultimately, I have never seen a more surreal environment in terms of global market risk and specific US market risk. And people say, well, Matt, the S&P is nearing 5,000. It's how can you be so cynical? You've been wrong. If I'd listened to you 15 years ago, I wouldn't have made a dime. It's actually not true. I traded bull markets or bull trends in the middle of a bearish backdrop or a bearish macro view. You can't trade a macro view month to month, day to day, year to year, but you have to be aware of the risks. And to answer your question about Egon in our book, which is about precious metals in general and gold in particular, it's more a book about global macro risk. This is something shared by Grant Williams, Ronnie Sturfula, Paul Tudor Jones, Ray Dalio. Again, you don't have to be shorting 100% of the market or always negative to be saying there is an elephant in the room here, despite all these opportunities short term. There's an elephant in the room here that is devastating to not only markets, but to politics, to national security, to social unrest. And that's debt, and that's financial inequality, that's wealth inequality. And what we're seeing in the 2020s, and frankly, which we've been seeing since 2008, is what I think is an extremely dangerous centralized economy, which is less and less the capitalism of my father or grandfather's ideal markets with supply and demand, balance sheets, free cash flow, financial statements, natural constructive destruction. When companies or markets are over their skis in debt or leverage, they should be punished. They should go down. When bonds are overstretched and they're overpriced, they should go down. When central banks intervene to the extent they have since really 1998, but in particular since 2008, to interfere with price discovery, to interfere with natural bond pricing by printing money to stave off risk in the bond markets, to effectively use money created out of nowhere to sustain the sovereign bond markets, whether that's in the US or overseas. That's incredibly dangerous longer term. And when you look at the debt levels, these aren't boring abstract debates for macroeconomists to talk about at conferences. They're absolutely going to have an impact on our lives. And no one knows when. That can be in 4 minutes or 4 years or 4 weeks, because there's all kinds of tricks to get liquidity into a system that's otherwise desperate for liquidity in the short term. And that short term, again, can be years or weeks. But the risks and the cycles that I've watched since the dot-com bubble, which we probably need an hour to go into each of those bubbles, whether it was the NASDAQ bubble or the subprime bubble or the pre-COVID bubble and the post-COVID reaction. They're all very detailed. Or ever really, if you go back all the way to when the Federal Reserve was created in 1913 to the 1920s bubble and FDR's reaction to that, and then Nixon, and there's so many places, or long-term capital management, there's so many places where the Fed intervened and completely distorted markets and allowed for debt to go too big. And then if there was a crisis, it was usually always a liquidity crisis because of too much debt. They will always solve that with more liquidity, but that liquidity came from an artificial source, from this creature from Jekyll Island, this central bank, which always bought more time, always saved the bond market, always saved the stock market. But it did so by postponing and postponing every crisis into another crisis. We solved the debt crisis and the subprime crisis of 2008 by creating an everything bubble post 2008. We solved the NASDAQ bubble, which was a dot-com tech crisis, and created a real estate debt crisis by using interest rate manipulation and Fed balance sheet manipulation to distort markets. But more importantly, we created a debt monster. And I'm not even talking about derivatives yet, which is a whole other thing. But again, boring stuff, and I won't go too deep into the woods on it, but when our federal government or our government public debt is at 34 trillion in the home of the world reserve currency in the US S&P markets. I don't want to just focus on America, but America is the home of the world reserve currency. The US 10-year is an important bond. The US Treasury is critical to derivative markets and global markets. When the home of that IOU and the home of that world reserve currency is this deeply entrenched in such extraordinary mud of debt, already at 34 trillion, it's 120% of its GDP, and the Congressional Budget Office is announcing another 20 trillion in IOUs in the next 10 years. That debt isn't just an academic discussion of, wow, isn't that insane? 40 trillion, 50 trillion in debt. Trillions are insane. It's not just a number that bears throw out there for some inevitable moment of uh-oh. It's happening right now, what that does to the economy, what that does to society, what that does to wealth inequality, what that does to the middle class, what that does to asset bubbles. That's happening right now, the distortions. And what I'm saying and what I'm most worried about and why we wrote that book and why gold falls into the conversation inevitably is there is no way to pay that debt. It will never be paid. It can't just be continually rolled over and repriced. There will always be a need for more liquidity. To do that, they will manufacture money out of thin air. I call it mouse click money. Some people call it printed money. It's just a mouse click. Inevitably, that does lead to currency debasement to save the system. So your S&P may go up or your bond market may go up, but to pay for that support, you're debasing the value of the dollars, Canadian, American, Australian, in your wallet to do that. So the solution is actually a poison. You don't see it. It's a slow frog boil. And that's why that's how I made the transition from just looking for my returns on my portfolio or my hedge fund investments to wait, what is my 20, 30% I made this year in US dollars? What does that $100 or $100,000 buy me that it didn't 10 years ago or that it won't 10 years from now? In other words, you can't just look at your income statement and say, well, I had a good year, a bad year, or you could be really cocky about a return, but you're measuring that in dollars that are losing their inherent purchasing power. That is not a gold bug apology or a gloom and doom statement. That is reality. And you can't ignore that, whether you're totally into speculation, whether you're chasing tops, whether you're a value investor, whether you're a trend follower or a CTA investor, whether you're long short, whether you're credit or macro, whatever money you're making every year, or whether you're a secretary at a dentist's office, whatever money you're saving or trying to invest, you're measuring that money in a currency that's getting weaker. That's just an objective fact. And since 1971, when Nixon took the gold standard off the US dollar, took the chaperone away so that central banks could print as much as they want, and presidents from Trudeau to Biden could print as much as they want to fill the gap in their liquidity needs, that just ruins the currency. And since 1971, the US and Canadian dollar have lost 95% or more of their purchasing power when compared against something as boring as that pet rock, a milligram of gold. So gold isn't a joke. It's important. It is important because we are saving our system at the expense of our currency. In that book, a long way around getting back to your question, I don't have to sell gold. I don't have to sell bonds. I don't have to do anything. I believe in it. Could be wrong. You can challenge me. There are plenty of people that think there are other things better than gold. I'm not here to say they're all wrong and I'm the only one who knows this or Egon's the only one who knows this. But a lot of us know or believe that our currency is just getting diluted, like a glass of wine that you pour too much water into, it loses its flavor. We've been doing trillions of pouring water into our currency wine for decades. It is affecting our currency markets, and we've been putting all those trillions into the S&P directly and into the bond market directly. So we've inflated the biggest S&P, Dow, NASDAQ bubble I've ever seen, and I saw the dot-com bubble. I thought that was insane. I thought that was insane. Then the 2008 bubble even higher. Where we are today is nosebleed levels ahead of that. So you are creating inflation in assets, risk assets, but it's very important for people to understand that 90% of that wealth in those asset bubbles has gone to the top 10% of the population. So that means the bottom 90% are getting poorer. The top 10% are getting richer. Their currency is equally debased, but the middle class is getting hurt the hardest. And what central bankers have done to wealth disparity and wealth inequality is appalling. And I'm in the top 10%. I don't say that with arrogance. I say that with a sense of shame, not because I'm part of the problem. I didn't design that structure, but I'm honest enough to say that that's not good for the top 10% or the bottom 90% when you have that much wealth inequality. Because when you have that much wealth inequality, you have social unrest, you have social division, you have a mass of a population that just knows they're not winning. They don't always understand why. They know there's something wrong in Wall Street and there's something wrong in politics, but they don't have the time to understand currency markets, bond markets, central bank policy, QE, QT, all these complex, fancy lad Wall Street lingo. They're just getting screwed. I see it objectively. I do. I see currencies being debased. I see asset bubbles that affect a small minority at the expense of the vast majority. I see guys like Oliver Anthony writing songs in Farmville, Virginia about how they're getting nowhere and how they're depressed. I see racial tensions, gender tensions, sexual tensions, political tensions. We can all get into the weeds on that, but the base of all those tensions is a lot of people. I even see drug tensions from fentanyl in Seattle to LA to San Francisco to New York to the back streets of London and other places of the world, because people that are losing hope, losing faith, losing equality, losing strength. It's a lot of it's not philosophical, political, gender, or sexual. It's economic. Economics are so important now. I see that far more at age 54 than I did at age 28 when I was some dragon slayer in the NASDAQ just getting lottery tickets. I see the historical ripple effect of these incredibly distortive policies that have created asset bubbles for a minority and created social tension and poverty for a majority, wealth inequality, and currency debasement. I don't see that as philosophical. That's happening right now. The evidence is right in front of us. And it's not just farmer strikes in the Netherlands or Paris or Italy or France. It's not just social unrest in Richmond or New York or Seattle. It's everywhere, because we have created an inequality and we've created a distortion of free market price discovery, and we've just created a distortion of currencies. Again, all of that is laid out in more hopefully plain spoken detail in the book that Egon and I wrote together. It is about gold, because gold is an antidote to those, doesn't solve all those problems. It's an antidote to that currency destruction and that distortion in credit markets and that distortion by central banks. But it doesn't solve all the other problems. And it's only for a very small minority who understand that. But as Andrew Jackson said, a central bank, and Thomas Jefferson warned against, it's the prostitution of our government and our currency at the expense of the many for the benefit of the few. He said that in 1852. Jefferson talked about that in the 1700s. But we're in 2024, and the evidence of that is everywhere right now. It's not projecting or predicting a market crash. It's not talking about what's going to happen next month, which no one knows. It's actually looking at the evidence right now of these asset bubbles, which have benefited me, and at this currency destruction, which I'm using gold to insure against, or this wealth disparity, which is all around me from the south of France to the south of Virginia. It's everywhere. And as an American European who spends time talking in German to Germans and to Swiss and to Italians and in French to French people, and in Michigan or Ohio or South Carolina or Georgia, I'm amazed. I'm amazed at the inequality I see. And I go back to America infrequently. Every time I go back to America, which is at a 9 or 12-month interval, it's worse. And I'm not talking Trump versus Biden. I'm just saying people are struggling more. The roads are less taken care of. The stores are more empty. The rich are still doing fine in Nantucket and in Palm Beach and playing polo with my wanker friends in Wellington. Like, I know it. I'm being honest. It's not comfortable. It is not comfortable because it's not right. And so Egon and I, who are not in a position to worry about paying the monthly rent, although there have been times in both of our lives, I'm sure we were when we were younger, we appreciate that people still are. And whether you're a millionaire or not, you can still try and protect your wealth with a coin or a bar of gold. Our argument is be aware of these things. Many, many cynical people say we're just selling doom and gloom or fear because we're salesmen, not fiduciaries. It goes back to my original thesis. And I understand that will always be that view. That's fine. I'm a fiduciary. I believe, like Egon and like Grant Williams and Ronnie Sturfula, all of us don't need to do this for a living, but we actually are trying to warn people, not necessarily to buy gold. That's up to you. But we are warning you that your currency is getting debased. Your politicians really aren't fiduciaries. They're salesmen. Your central bankers have a vested interest in keeping the markets alive by sacrificing the currency. And your social problems aren't going to be saved by someone from the left or the right. Not even Santa Claus is going to save you, or Papa Smurf, because the damage is already done now. The debt levels are too high. The governments are broke. A minority have too much power. Our currency is at risk. It doesn't mean the end of the US dollar. It just means it's not the same dollar or the same Canadian, Australian dollar. It's certainly not the same peso in Argentina. It's certainly not the same kroner. It's not even the same Swiss franc. Because all these countries have been living on debt and solving one debt crisis after the next with another debt crisis paid for with money literally created out of thin air. Even a 10-year-old would know that's not a solution. That's just postponing and buying time. And everyone asks, well, when's it going to break? Well, it's already broke. It broke in 2020. It broke in 2008. It will break again. It keeps breaking. We keep putting Band-Aids or lipstick on a pig with new fiat money. It just keeps getting worse all the time. No one knows what happens in the next 10 minutes or 12 weeks. We can look 12 months or a year out. As I've said many times, I don't have to be a weatherman to look out the window and say, all right, Those are very dark clouds. It's going to rain at some point. I need an umbrella now. Don't ask me what time of the day it's going to rain. I just see rain. Egon and I wrote that book because we see a lot of rain coming and a lot of rain pouring. And a lot of people just need to understand the forces behind all this distortion. And there are a lot of great books, a lot of great articles that talk about this. It's hard to do in 45 minutes to a half an hour in a conversation. But I've spent the last 20 plus years watching how the sausage is made, looking at the nonsense that comes out of the FOMC, looking at the nonsense, the ignorance of our congressmen and women, left or right, who had no understanding of basic supply and demand, of capitalism, who are all attached to lobbyists who tell them how to vote and how to do policy, who don't understand deficits. They don't understand that there's no such thing as a free ride. You can't have 34 trillion in debt and have growth. It's mathematically impossible. Once your debt to GDP ratio gets to 120, once your deficit to GDP is at 8%, it's like you trying to play water polo with two cannonballs tied to your ankles. I don't care how much you've trained, how good you are. At that point, you can't swim like an effective swimmer. And an economy can't grow in an effective way on debt like that. It simply can't. Get past gold, get past the S&P, cryptos, NASDAQ. Look at these realities. Hold the sources who are responsible for that accountable, because they'll never take responsibility. It comes from the bathroom mirror of our politicians and central bankers and the too big to fail banks that I was part of, that they bailed out, that we're paying for. And unfortunately, that minority is still in charge. I'm not calling for revolution. I'm calling for accountability. We're writing books to get people more informed, more educated, more aware, not just angry, because emotion does nothing. Emotion is not going to solve a debate. Emotion, whether that's in Palestine, in the Arab-Israeli crisis, or in the Ukraine, or on Wall Street. If you're just going to be emotional and be a victim and point a finger and be angry, whether it's race, gender, politics, that's useless. Get informed, get knowledgeable, and then ask smarter questions to that congressman, that central banker, that private wealth manager, that gold seller, that pundit on the legacy media who just asks softball questions to one person and hard questions to another. Get informed. And the book was a way of just informing people about the incredible distortions in these markets. And I will say for your listeners, there is a great book by David Stockman, who's from my hometown in sleepy old Michigan, called The Great Deformation. It's an exceptional book. It's not as entertaining as Liar's Poker or those other kind of books, or Lewis books, but it's a history of these distortions in detail. It's a read. It needs a pencil and a patience and a magnifying glass and a pen. If you read each page and you're really curious about markets, Stockman is one of the best, and he's more of a fiduciary than just another political salesman, in my opinion.
I appreciate that answer there of, explaining why gold matters. Sometimes things play out a little slower, right? So my question to you is, if your thesis is wrong, what would have to happen for that to play out?
Yeah, look, I mean, you could take a bull case and a bear case, and my thesis is we're too far in debt. The only way to solve that debt is to print more money, debase the currency, and we'll have hyperinflation regardless of how it's misreported officially. We'll just have a diluted currency. That's my thesis in a nutshell. Our debt's too big. Tax receipts and GDP will never pay for it. Growth will never get there. We're already past the Rubicon. There's no easy solution other than real fiscal austerity. And so, and a debased currency. The counter argument would be, well, we could cut spending, entitlements, military spending, entitlements by 40%. We could tighten our belts. We could be like Javier Milei and admit that we're broke. Politicians in the West won't do that, but you could argue we could cut spending dramatically, cut our military budgets dramatically, bring manufacturing back to the US where the American dreams went offshore to China, and start over again. There's an argument to be made there. The other argument is, well, we can't print trillions more money to save the markets, so we'll have some type of Bretton Woods 2.0 or a Plaza Accord where all nations will sit down and just admit that we blew up. They can blame it on Putin or COVID, global warming, Martians, but let's just admit there's a problem and let's fix it and let's reshuffle the debt. Well, again, that's a counter argument, some kind of debt jubilee or a Plaza Accord or a Bretton Woods 2.0. The world just comes to a good John Nash moment. We all cooperate. It's possible. We cut spending. It's possible. I could be wrong. I don't see the pattern I've seen since 1913 in the unimmaculate conception of the Federal Reserve, which is neither federal nor reserve or even constitutional, in my opinion. But since 1913, we've solved every problem by manipulating interest rates or printing money, mouse clicking money. And that just debases money. That's why the dollar you had in 1913 isn't the same value as an ounce of gold you would have bought in 1913. It's just that simple. The gold holds its value, the currency, the fiat currency doesn't. But and we have gone through gold backed and ungold backed cycles, but fiat paper money is just incredibly useless. But yeah, you can take the counter argument that we could cut spending, cut entitlements, have a more austere, honest new political leadership that admits that we're broke and that we have to change things. You could have a global cooperation where we try and restructure debt, but if you try and restructure debt, there's always winners and losers. It's very hard to get cooperation. I have seen throughout history, whether it goes to the Romans, the Ming Dynasty, uh, Weimar in the 1930s, obviously extreme examples like Zimbabwe, which is an outlier, or even Yugoslavia in the 1990s, or France in the 1780s or 1720s under John Law. Every single time a country is in debt, it debases its currency. That's what I see. I don't think that's any exception now as it was in the past. That is without exception every single time. Now, there could be an exception this time. I'm not saying this is what will happen. It's what I strongly believe will happen. And that's why gold has held its value despite never going in a straight line, far better than fiat money. It just has. That's why gold is ignored by the Federal Reserve. It's why it's ignored by Greenspan, who wrote his thesis on gold, but then forgot about it once he was a politician, once he was a central banker. That's why it's ignored by Goldman Sachs and Morgan Stanley. They can't churn it. They can't fee turn it. They don't talk about it. It's the biggest fear of Volcker. It's the biggest fear of Powell. What's the gold price doing? Because when gold rises, that's an insult to fiat money. That's why it's never discussed. That's why 0.5% of the population own it. No one else in the risk asset market. Everyone's chasing other things. I can't give the names of our clients or where they are, but from 90 countries, you'd be amazed how sophisticated and smart our clients are who buy gold. They don't care what the daily price is. It's not about trusting gold. It's about not trusting fiat money, central banks, and broken regimes, of which America's one of many. It's not like China's doing well. It's not like Japan is doing well, or the European Union is doing well, or the UK, or certainly Venezuela and Argentina are doing well. It's a multipolar, multi-dysfunctional world right now when it comes to currencies. But I don't see a way out of the currency debasement. Hemingway's argument is inflation and war. That's another dark view, that when you get to this point in the road, this fork in the road, the governments will distract the population on war and a boogeyman because the politicians are too afraid to admit that it's their own fault. That's a darker view. It's one that can be argued or debated. We are seemingly at permanent war in my country since I was born. None of them have gone too well since Vietnam. Is that deliberate or is that stupid? I don't know. Is it evil? Is it stupid? I don't know. That's debatable. But certainly the currency destruction is not debatable. It's happening in plain sight. It has nothing to do with the dollar's relative strength. It's its inherent purchasing power. The dollar can be the best horse in the slaughterhouse, but it's still a horse in the slaughterhouse. And so I don't really care what the DXY says about the dollar's relative strength. I look at its purchasing power, what you could buy, what the cost of a Big Mac was in 1968 versus the cost of a Big Mac in 2024. That's inflation. That's currency risk. It's simple, stupid. You don't need to get all these fancy guys with MBAs from Harvard to tell you that that's fine, or a central banker to tell you that inflation is transitory. It hasn't even begun, in my opinion. But again, all of these are dark views. The solutions are some type of restructuring, some type of belt tightening, some type of political cooperation. If you can make that case, great. What I would not believe is a politician who says it's Putin's fault, or it's global warming's fault, or somebody from the World Economic Forum. I know a lot of people at the World Economic Forum. I've not met one who I remember from Harvard or any other fancy school that was sincere. It's an opportunity for them. It's money. That's salesmen. Those are salesmen. Those aren't fiduciaries. Those are opportunists writ large with an altruistic message that they're there to make the world better. I have not met one. Well, that's not true, but most of the guys I know who went to the WEF to become young global leaders were total hypocrites. That's just a very dark view I have. That's my experience. I'm sure they'd say the same about me. I'm just a hedge fund guy who made money and put it in gold, just selling his book. It's fine. But, I think everything that Egon and I have written about, that Ronnie's written about, that Grant Williams has warned about, heck, Paul Tudor Jones is talking about, even Ray Dalio was warning about. Jeremy Grantham at GMO, I allocated that fund. These are smart guys. They have different views on different sectors. We all agree on gold. I was listening to a great debate between a gold bug and a crypto guy, and they both had different views on crypto, but they both agreed that gold would do well. I had a debate with Brent Johnson about the U.S. dollar going up or down, but we both agreed gold would do well. Jeremy Grantham and Ray Dalio have different different portfolios, but they both agreed that gold will do well. In other words, gold really isn't such an outlier. And you can be totally pro crypto. I'm hopeful for crypto. I'd want to see crypto defeat the fiat currencies. I'm not here to knock crypto at all. I just think gold is a more stable version of currency insurance. But gold always pops up, but it's the least loved and least understood asset. And I think there's a reason for that. And I've always been a little bit of a contrarian, but you shouldn't just look at gold because you want to be contrarian. You should understand it. There are plenty of cases to be made against gold, plenty. And I've looked at them and I've written about them. I try to be objective, but maybe even I'm not objective. Egon and I always joke, we're so convinced that gold is the best thing that we're worried. How can we be this convinced? There must be something we're missing. Will the gold market be confiscated like it was in 33? Will there be a Thomas Amendment? Will governments make it illegal? Will they tax it? They could do the same to crypto. They could do the same thing to us. We could have an Armageddon. I don't know. We can't solve every problem, but the problems we're looking at right now and the realities we're looking at right now, it's the best asset that I can think of for preservation, not for appreciation. If you want to go take speculation risks like I did in my 20s, go for it, but be ready for that risk. You won't always be as lucky, not as smart, but as lucky as I was. I didn't get smart until after I was lucky, but then I had to get smart.